50 Wise Benjamin Graham Quotes on Successful Investing. The author of The Intelligent Investor. If the reason people invest is to make money, then in seeking advice, they are asking others to tell them how to make money. That idea has some element of naivete. People without experience or superior ability may make a lot of money fast in the stock market, but they cannot keep what they make, and most of them will end up as net losers. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Buy not on optimism, but on arithmetic. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. You must never delude yourself into thinking that you're investing when you're speculating. Successful investing is about managing risk, not avoiding it. The essence of investment management is the management of risks, not the management of returns. Investing isn't about beating others at their game. It's about controlling yourself at your own game. Though business conditions may change, corporations and securities may change, and financial institutions and regulations may change, human nature remains the same. Thus, the important and difficult part of sound investment, which hinges upon the investor's own temperament and attitude, is not much affected by the passing years. Buy when most people, including experts, are pessimistic, and sell when they are actively optimistic. Before you invest, you must ensure that you have realistically assessed your probability of being right and how you will react to the consequences of being wrong. Good management produces a good average market price, and bad management produces bad market prices. The stock market resembles a huge laundry in which institutions take in large blocks of each other's washing without rhyme or reason. Best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. The genuine investor in common stocks does not need a great equipment of brain and knowledge, but he does need some unusual qualities of character. An intelligent investor gets satisfaction from the thought that his operations are exactly opposite to those of the crowd. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Successful investing professionals are disciplined and consistent, and they think a great deal about what they do and how they do it. The individual investor should act consistently as an investor and not as a speculator. The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. While enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street, it almost invariably leads to disaster. It requires strength of character in order to think and to act in opposite fashion from the crowd, and also patience to wait for opportunities that may be spaced years apart. The true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operation results of his companies. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. Before you place your financial future in the hands of an advisor, it's imperative that you find someone who not only makes you comfortable, but whose honesty is beyond reproach. The best values today are often found in the stocks that were once hot and have since gone cold. To have a true investment, there must be a true margin of safety, and a true margin of safety is one that can be demonstrated by figures, by persuasive reasoning, and by reference to a body of actual experience. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. The investor's chief problem, and even his worst enemy, is likely to be himself. We have not known a single person who has consistently or lastingly made money by thus following the market. People who invest make money for themselves. People who speculate make money for their brokers. On the other hand, investing is a unique kind of casino, one where you cannot lose in the end, so long as you play only by the rules that put the odds squarely in your favor. Buy cheap and sell dear. A great company is not a great investment if you pay too much for the stock. In the world of securities, courage becomes the supreme virtue after adequate knowledge and a tested judgment are at hand. Individuals who cannot master their emotions are ill-suited to profit from the investment process. Once you lose 95% of your money, you have to gain 1900% just to get back to where you started. Losing some money is an inevitable part of investing, and there's nothing you can do to prevent it. But to be an intelligent investor, you must take responsibility for ensuring that you never lose most or all of your money. The whole point of investing is to not earn more money than average, but to earn enough money to meet your own needs. The fault, dear investor, is not in our stars and not in our stocks, but in ourselves. Investment is most intelligent when it is most businesslike. Without a saving faith in the future, no one would ever invest at all. To be an investor, you must be a believer in a better tomorrow. Correct attitude of the security analyst toward the stock market might well be that of a man toward his wife. He shouldn't pay too much attention to what the lady says. But he can't afford to ignore it entirely. That is pretty much the position that most of us find ourselves, vis-a-vis the stock market. If you are shopping for common stocks, choose them the way you would buy groceries, not the way you would buy perfume. Always buy your straw hats in the winter. It is absurd to think that the general public can ever make money out of market forecasts. In market analysis, there are no margins of safety. You are either right or wrong, and if you are wrong, you lose money. If all that can be promised is an average result, how can managers expect to be paid large fees for providing that average result?